everyone, are you generally aware about our topic? We should go into great detail about this topic as I will start with an introduction. So, what is actually passive investment? Passive investment refers to an investment strategy in which an individual or entity allocates capital to investment vehicles or funds with the goal of achieving long-term returns while minimizing active involvement in the investment decision-making process. Instead of actively choosing and managing individual investment, passive investment seeks to mimic or reproduce the performance of a certain market index or benchmark. Wait. My part is not done yet. So the next one is the importance of active income generation from passive investment. The first one is financial stability. A more solid financial state is ensured through active income generating. Individuals who have active incomes are able to support a steady way of life and meet their urgent financial needs. The second one is flexibility and control. Individuals have the freedom to choose how and when they make money, and they have the chance to boost their earnings potential through skill improvement, career promotion, or business ventures. The third one is accelerated wealth creation. Compared to merely depending on passive investment, active income has the potential to yield large returns and accelerate the process of wealth creation, and enables people to actively engage in the economy, seize opportunities, and others. Now I will pass to the next presenter, Umi.
Hi guys, so let's continue with the types of passive investment and how it is different from traditional investment, shall we? Before we go further, do you guys know what are the concepts of active income from passive investment? Let me tell you, it is the earning active income through direct involvement or participation in investment activities that generate passive investment returns. In the other words, it involves actively managing or leveraging passive investment vehicles to generate additional income. It's okay if you don't get it. You will see after I explain about the types of passive investment. Now, let's talk about the types. So, the first one is rental properties. Rental properties considered a form of passive investment due to the income being generated passively. It is because rental properties involve purchasing residential or commercial and leasing them out to tenants in exchange for rental income. Active income can be generated by actively managing and optimizing the rental property business. By actively managing these aspects of a rental property business, individuals can generate additional income beyond the passive rental income. Second one is vending machine. Vending machines are automated retail machines that dispense various products such as snacks and beverage. As a passive investment, vending machines generate income passively through the sale of products. However, individuals can actively manage and optimize their vending machine business to increase income and generate active income. And lastly, dividend-paying stock. Dividend-paying stocks are the shares of companies that routinely distribute a portion of the company's income to their shareholders in the form of a capital gain. It is possible to create dividend income by investing in stocks that pay capital gain. Because you have to monitor the performance of your assets, review financial reports, and choose which stock to fund to invest in, this type of income is considered to be an active form of income. So how it is different from traditional? In the term of strategy and decision making, passive investment involves replicating the performance of a specific market index or asset class. Investors achieve this by investing in index funds or exchange traded funds that track the composition and weightings of underlying index. The strategy aims to match market returns without attempting to outperform the market actively. While traditional investment encompasses a wider spectrum, including both active and passive strategies. Active traditional investment entails actively selecting and managing individual investment with the goal of outperforming the market. Investors make specific investment decisions based on analysis, research, and their own judgment. The second one is involvement and time commitment. Passive investing like stocks and dividends or house rental requires minimal time and effort as investors adopt a buy and hold approach. Once the index fund or ETF are selected, investor can passively participate in the market. As the portfolio composition and weightings are automatically adjusted to reflect the underlying index, this approach is suitable for individuals who prefer more hands-off investment style. While traditional investment like trading, especially the active approach, demands a higher level of involvement. Investors must continually monitor their portfolios, analyze market trends, and actively make investment decisions. This requires a significant time commitment and a deeper understanding of investment strategies and market dynamics.
Now, of course, we'll learn the benefits and drawbacks of passive investment, right? So let's move to the benefits of passive investment first. Compared to active investing, passive investing needs less time and effort. A passive investment vehicle, such as an index fund or ETF, can be chosen by an investor and won't require ongoing monitoring, investigation, or even decision making. This frees up time for other pursuits and allows investors to spend less time managing their money. And in terms of performance consistency, passive investment aim to match the performance of the underlying index or asset class they track. While they may not outperform the market, they also have the advantage of not underperforming it significantly. Over the long term, passive investments have the potential to generate consistent market-aligned returns. So, while passive investment has numerous benefits, it is also important to consider the potential drawbacks as well, right? So, some drawbacks associated with passive investing are limited control and concentration risk. Passive investors have limited control over the composition of their investment portfolios. Since passive investments aim to replicate the performance of a specific index or asset class, investors are generally unable to make active decisions to deviate from the index holdings or weightings. This lack of control can result in exposure securities or sectors that may not align with an investor's preferences. Passive investment also has potential for concentration risk. If the underlying index or asset class is heavily weighted towards a small number of securities or sectors, passive investments may have concentration concerns. If those particular stocks or industries face negative events, this concentration might expose investors to potential losers.
Hi! Alright, so now I think you might be confused on actually what are the differences between active income and passive income. Don't worry, I got you. Firstly, active income refers to income that requires physical involvement and material participation. It is typically earned through traditional employment where individuals work under a boss and report to them, while passive income refers to income that can be earned with little or no effort and without material participation. It typically involves generating income from investments, real estates, royalties, or other sources that do not require active involvement. Secondly, in terms of consistency, active income provides a quicker and more regular income stream compared to passive income. This is because it is directly tied to the time and effort invested in working or providing services. Unlike active income, passive income may take longer to accumulate and might not be consistent. It often requires upfront investments or efforts that yield income over time. Thirdly, lifestyle effect of active income generally requires a lot of time and work. This can leave people with little energy to pursue their hobbies or spend time with their families. But passive incomes give people more time and flexibility. Individuals can spend more time on hobbies, personal interests, and relaxation with passive income streams. Fourthly, in terms of taxability, active income is typically taxable income subject to applicable income tax rates and regulations, while depending on sources and tax legislation, passive income may be deductible. Income-generating asset management costs may be deducted. Then, in terms of end results, active income requires a awake, active, committed, and continuous effort to earn revenue. It depends on the individual's active participation in job or company activities, while passive income can be earned even when the individual is not working. It can generate income while sleeping, vacationing, or doing other things. Now, what are the factors influencing the potential for active income generation? First, skills and expertise. The amount of knowledge, skills, and expertise in a specific profession or industry can have a substantial impact on the possibility for the active income production. The more specialized and in-demand your abilities are, the more prospects for the revenue you will have. Next, education and training. Having a better level of education and related training might raise your marketability and your capacity for active revenue generation. Then, market demand. The market demand for the product or service you provide is critical in establishing the possibility of active income production. Understanding market trends, detecting loopholes, and targeting a specific audience can all help you maximize your earnings. Also, persistence and resilience. Active income development frequently necessitates perseverance and resilience in the face of obstacles and disappointments. Adaptability, learning from failures, and being motivated can all help you succeed. Furthermore, time and effort. The amount of time and effort you are willing to put into income-generating activities can have a direct impact on the prospective rewards. To get the intended benefits, active income often necessitates constant commitment and dedication. With that said, let's listen to the news report by Farahin.
Hello, now you're back with me, Farahin. I would like to share all the strategies that you can use for maximizing your active income. First is through business profits. Individuals who operate as sole proprietors of a company have the chance to actively earn income by actively participating in the day-to-day activities of their business. Second is through bonus or tips. There are some distinctions between bonuses and tips for different types of employees. While salaried employees typically receive bonus frequently, possibly once a year. For servers, they have the potential to earn tips multiple times within a single shift. For example, when a waiter or waitress provides service to customers in a restaurant, it is customary for customers to leave tips as a gesture for gratitude for the service rendered. Third is from salary or wages. This is the second most significant source of income, accounting for approximately 60% of the total earnings. In essence, the more time individuals dedicate to their work, the higher their income potential. Next is side hustle. The active side hustle demands greater work, effort, focus, and concentration compared to a passive side hustle. An active side hustle can be exemplified by starting a YouTube channel. These examples of active side hustles involve continuous activity, active participation, and ongoing responsibilities. Last but not least, active management. The term active management is often used to describe the approach used by professional money managers who aim to outperform the market by studying market patterns, undertaking fundamental research, using technical analysis, and applying quantitative methods. Let's say an investor has a portfolio of stocks and wants to actively manage it to achieve higher returns than the market. The investor will need to conduct detailed research, analyze financial statements, market trends, and economic indicators to identify undervalued stocks with growth potential. Finally, through commissions. In the case of real estate agents, they typically receive a percentage-based commission when they successfully sell a property or lease it out. This commission is often a percentage of the total sale price or a fixed percentage of the lease value. It is important to note that commission-based income can be more variable and less predictable compared to fixed salaries or hourly wages. That's all from me. Thank you.
I'm back. So, to conclude, the concept of combining active income with passive investment provides a compelling method for individuals wishing to improve their financial prospects and accumulate long-term wealth. Individuals can develop a consistent and reliable stream of income by leveraging active income, allowing them to cover living expenses and others. That's all from us. Thank you very much. Bye.